Click the bell icon to get latest videos from Ekeeda.
Hello friends, we'll be discussing certain details about revaluation account for your reference. This account is also known as profit and loss adjustment account. So when we discuss about revaluation account, this is basically a part of admission of partner itself. Now what admission of partner mean has been already discussed in the previous videos. Some new partner is admitted to the new existing firm, and that is done so that you can have more hands for the management basis. Now, when this happens, you need to understand that whenever there is a new partner that is admitted, there are a lot of changes that is done. It might be the change from the profit sharing ratio, and there might be certain changes in the value of the assets that are being brought up by this new partner to the existing firm. Now, whenever this thing happens, you need to go ahead and prepare an account which is utilized for changes in the existing assets and liabilities of the firm, because the capital ratio will change, the assets will change, the liability will change, and everything will change with this new partner coming into the business. So what we do is that we prepare a specific account for this, that is revaluation account. Now this account is prepared especially whenever a new partner is supposed to be admitted into any kind of business or any kind of firm. This account is prepared so that any changes in the value of the assets, liabilities, capital are mentioned in this account, and the final difference is then posted to the capital account of the old partners in the old profit sharing ratio. So when we see about these highlighted options, if you can see, everything is highlighted under green. Now these points are related to the revaluation account. So assets are reassessed, liabilities are revalued, and then we further go ahead with preparation of revaluation account. So any difference, or rather the journal entries which we'll be doing further in this video, will make you understand what all things are mentioned on the debit side, what all things are mentioned on the credit side. Once both these items are mentioned down here, the difference of it is moved to the partner's capital account in the old profit sharing ratio. Make sure this word is emphasized on old profit sharing ratio, because that is supposed to be very important and the critical aspect of this specific account. Now once this is done, you get that all these assets are now at a revised value. So whatever asset was there earlier at a specific value, that has been moved to a revised value now. So your balance sheet will show a revised value of assets, a revised value of capital account, a revised value of liabilities itself. So all these things will be at a revised value here. So if you see, I've highlighted the same line with blue. So capital, assets and liabilities will be revalued, a new value will be added to them, and the same value will be reflected in the balance sheet as a revised balance sheet for us. So whenever we have to discuss about revaluation account, make sure all the increase, decrease in assets, liabilities, capital balances is taken into consideration. It is mentioned into the revaluation account with the journal entries that we'll be doing in this video, and accordingly the difference is then moved to the partner's capital in the old profit sharing ratio. That's the end of revaluation account. That's the reason why a revaluation account is prepared, because every time a new partner is admitted into the firm, there are a lot of changes the firm goes through, and to be updated according to the current market value, we have to make these necessary changes. So that's the reason a revaluation account is prepared. Now let's figure out what are the journal entries that we need to pass in such a scenario. Okay, so what needs to be done in this kind of scenario is the first journal entry that will be passing here. Now, whenever revaluation account is supposed to be prepared, revaluation account is debited if in case there is a reduction in the value of asset and there is an increase in the value of liability. So either of it, if there is a reduction in the value of asset, supposingly building was valued at 10 lakh rupees and after admission of new partner it is now valued to 8 lakh rupees. So the difference between them is moved to the revaluation account. So that is done because there is a reduction in the value of assets. Similarly, if the liability of capital, or rather we can say that the loan liability was around 10 lakh before revaluation was done, and after revaluation we have figured out that the liability or capital liability of loan liability has gone above 15 lakhs. Now the difference is then moved to the revaluation account. So in both these scenarios where there is a decrease in the value of asset, or if there is an increase in the value of liability, all these things will be debited to revaluation account. So the entry first will be revaluation account debit to assets account to liability account. In case there is a decrease in the value of asset, individual assets have to be considered, individual liability has to be considered for sure. You cannot just take the total of the liability side and asset side and move it there. So individual liability and individual asset has to be taken into consideration. So when we talk about revaluation being debited, that is only for two scenarios: either the asset side is getting decreased or the liability side is increasing. This is there. Now let's go on to the next journal entry. Now the second entry refers to if there is increase in the value of asset and decrease in the value of liability. So we have highlighted there with blue tick marks. So if there is increase in the value of asset and decrease in the value of liability, in both these cases revaluation account will be credited. That's correct. Revaluation account will be credited here. So if the asset value of building, let's take for example, building value was 10 lakh rupees. After admission of new partner, when the revaluation was done, we figured out the value of the building has gone to 12 lakhs. So this scenario will tell you that there is an increase in the value of individual assets. So that thing will be mentioned here, and the revaluation account will be credited with the specific asset account being debited. Similarly, if the liability is paid off or if the liability value is going down, then in that case liability will be debited and revaluation will be credited. So it's a vice versa game that we need to understand, that if there is increase in the value of asset, debit that asset account and credit the revaluation account. If there is increase in the value of liability, then in that case liability account will be credited and revaluation account will be debited. Similarly, if there is decrease in the value of asset, debit or rather debit the revaluation account and credit that asset account. And if there is decrease in the value of liability, then liability account will be debited and revaluation account will be credited. It's a cross connection that you have to figure out. So this thing is there when we talk about revaluation accounts being credited or debited. Now once this is done, there will be certain difference. There will be debit side will be higher or credit side will be higher. Now the difference is something that you have to go ahead and figure out what needs to be done. That will be done in the next journal entry. Let's figure that out now. So now in case of profit, in case of loss, what are the journal entries that needs to be passed? Now in the first case, when there is a profit, that means either the credit side or debit side is what we have to consider. So revaluation account will be debited. To old partners capitals account will be credited. Now revaluation account debit to old partners capital account, this entry is supposed to be passed when there is a profit. So revaluation debit side will be more, that means credit side is more as compared to the debit side. So when we talk about such scenes, that means credit side will be on the higher side, debit side will be on the lower side. So revaluation account debit, that is a profit scenario. Revaluation account debit to old partners capital account, that is just like a trading account that we prepare. Similarly, on the contrary side, when revaluation account is credited and old partners capital account is debited, that is a loss scenario. That means the revaluation account has gone with the loss part. So that means debit side is more, credit side is less. less. So that adjustment has to be made. So this is the closure of revaluation account that we are discussing about. And after this, in the balance sheet, all the assets will be shown on the revised value. That means all the revised value assets will be mentioned there. The existing assets which has no change, no changes is supposed to be done, that will be continuing with the same value itself. However, the assets that are changing will be shown on a revised value here. So this is how you prepare a revaluation account with all these basic journal entries that is supposed to be passed, with the profit and loss being determined on the basis of the credit and debit value of that specific asset. So I hope this video gave you a clarity about revaluation account and how it is supposed to be prepared. So thank you for watching this video. Stay tuned with Ekeeda and keep subscribing to Ekeeda.